oil is going to hit $40 a barrel. A lot of alarmist headlines. And look at where we are now. We're at $90 oil, and we even briefly topped $100 oil. And our thesis there, which we correctly called, we couldn't have foreseen why it was going to increase, but we just knew that oil doesn't stay low for too long. And that's because when oil stays too low, companies go out of business and companies and countries together cut back on production. Okay. Hey everyone. Keshav Kolur here from Clive Capital, joined by my partner, John Lai.
Hi, everyone.
And today we're excited to present to you our Q2 2026 quarterly report. Just what we saw, what we did, what happened in the world, all of that. And this is with Clive Capital. So, John, kick us off.
Very good. Really quickly, table of contents. We're going to cover economic overview, a little bit about what's happening in the world today, how it's affecting our portfolio, and our thought process in terms of how we look at the world, the actual portfolio performance of our investments to date. And then we're going to talk about company updates and also what's next. What can you expect from us? So, a quick disclaimer, as always, we're not financial advisors. Please consult your CPA, your lawyer, and your financial advisor before making any investments. And all investments are subject to risks of loss. So please do consult your advisors before making any investments. So very quickly, Clive Capital, what we do, we underwrite and invest in investments that are worth hundreds to millions of dollars. And we also do so to allow our fund managers, you, to passively invest in any of those investments so that you don't have to be a full-time investor. We have over 100 investors to date. We've allocated over close to $13 million in these alternative investments in the hopes of providing generational wealth for you and your loved ones. We're getting into other types of capabilities such as tax strategies, asset protection, life insurance. And so you'll expect that we'll be providing more of those capabilities in the upcoming slides. Keshav, you want to kick off a little bit about yourself and how you got to where you are today?
But yeah, I made my first investment into 108 apartments in San Antonio, Texas, coming up on 5 years ago now, almost, and then saw that investment working, delivering passive income. So started Clive Capital in January of 2022 to partner with the best companies out there across multiple industries, real estate, private lending, oil and gas, etc., to provide these same investment opportunities and educate our fellow high earners, especially in the tech industry, but other industries as well. And I've previously worked at Amazon and Meta, and a lot of our folks are from those high tech companies.
And I met Keshav at Amazon, so I'm happy for that. Thank you very much for that meeting. I have been investing for about the bulk of my career and only really started getting into alternative asset investing for the last about 10 years or so, starting with multifamily, getting into oil and gas, eventually into private debt and other types of asset classes. We're expanding into others as we determine that our needs expand. And I am grateful for what we've built at Clive Capital and then what we continue to build with our tax strategies and other capabilities. So with that, let's go ahead and get into the economic overview. So first, let's talk about the GDP, inflation, and the Fed. We do know that GDP prices have been a little bit higher, but has softened recently. So Q2 2026, real growth came in at 1.5%, which is softer than what the Fed was expecting at 1.7%. But it's below the 2.2 and 2.4 pace that we began with at the beginning of the year. That was primarily due to the Iran war, which we'll cover in a little bit. But inflation from the CPI perspective has cooled a little bit to about 3.4%. That's primarily because energy has fallen because of the memorandum of understanding. Again, we'll talk about that in a little bit, but it's still up about 14.7% year over year. And then from a jobs perspective, payrolls unexpectedly fell about 23,000. And unemployment, though, has actually ticked down about 4.1%, with wage growth cooling about 3.2% year over year. So it's a kind of a narrative whiplash where jobs, we're seeing slight decline in terms of the number of payrolls. Unemployment has ticked down, which is good, but we're seeing inflation slightly creeping up, and the Fed has to address that in a little bit. One other significant indicator is that 30-year Treasury yields have hit a 19-year high because primarily of fiscal deficits. We have about close to $40 trillion in the U.S. deficit, and we're paying about $1.2 trillion in interest, the U.S. government is. So that's very significant. And that's also due to corporate borrowing to fuel the AI growth, which we'll talk about as well. That has downstream effects because of the 30-year Treasury yield being so high. That has raised the cost of capital for things like mortgages, if you want to buy a new house, or car loans, or credit cards. That has a downstream impact of dampening consumer spending. So that has decreased, and then housing prices have remained stagnant. We're seeing, instead of a K-shaped economy, we're starting to see a C-shaped economy where the upper income individuals, the strata, is cutting back on some of the spending that they used to be in the K-shaped economy. And then the lower income strata is actually spending more because of all the effects of the Iran conflict on just typical goods that are shipped. Oil is just getting more expensive, and that has an impact across the board. Under the Fed, the new chairman, Kevin Warsh, he has held interest rates steady at 3.5 to 3.75% in July, but we are seeing dissent from the board in terms of favoring a hike. It'll be interesting in September. There's a higher than likely chance that the Fed will keep interest rates the same and they will not raise them, but the weak jobs report and the soft CPI, I think that's causing them to halt any interest rate hikes for now. But we will see that there will be mounting pressure to actually increase interest rates. The takeaway from an investor perspective is that because uncertainty is getting a little bit worse, we like to be conservative. We like to keep our assumptions conservative in terms of cap rates, in terms of exit assumptions, in terms of the expected interest rates, so that we can minimize refinancing. Okay, let's move on to the Iran war. Okay, so the Iran war, essentially it's back on. I'm not going to go over the timeline. We started in February timeframe where we initiated the Iran war that inflated the price of oil. And so what we're seeing now is there was a memorandum of understanding back in the June 17th timeframe. Since then, that MOU has effectively died, even though there is a truce. There might be a little bit more conflict in the near future. But what has that done with oil? That has essentially kept the price of oil pretty high. Where we started with at the beginning of the year was about $50 to $65 per barrel of oil. Now, and this is Brent crude, now we're moving up to about the almost 100, I would say 90 to 98 points level. And we're seeing it steadily creep up and down depending on what happens on a day-to-day basis. And what we'll eventually see is that the U.S. will have to do something, and then Iran will counter with something else. For now, I think oil is moving up and down. Analysts do say that the price of oil hasn't risen to about 150, which was the expectation, primarily because of the China's resources. China had roughly about 1.3 billion barrels of oil in its reserve, and it's been selling that off in the market. So that's been depressing the price of oil a little bit, keeping it around the $100 price per barrel point. But the net effect of that for us as investors is that U.S. oil, U.S. shale remains the clear winner. U.S. producers are producing a fresh record of about almost 14 million barrels of oil per day in April. and will continue to produce. And that's just been a boon for oil for U.S. producers. So that's oil. Let's go ahead and talk about AI trade. AI, we've seen the stock market run up to record highs. In fact, the top 10 U.S. stocks are now at a record 41% of the S&P's value. And just the Magnificent Seven alone is accounting for about 33%, 35 cents of every index dollar, which is amazing, but it's also causing a lot of fear in the market for those that have invested and see that the run up might be a bubble. And what investors have said, analysts have said, Goldman Sachs, JP Morgan have said that the funding of the AI build out, data center capex, in other words, has been funded from operating cash flow, which is much better than funding from debt, which we saw in the dot-com era. So that's a good sign. Now, the counter to that is that Chinese AI, DeepSeek, now Kimi K3, what we've seen in and from China is that China has about a 3-month lag in terms of catching up to the forefront LLMs that Anthropic, that OpenAI can put out. And what that does is cause equity volatility. If they are competitive in terms of the token pricing, they are causing token pricing pressures. And we saw recently, just last week, that OpenAI and Anthropic have decreased the prices of their tokens to remain competitive with Kimi K3, the Chinese AI LLM that's being put out. And because of that, that will depress the prices, the profits that the US LLMs, the US AI providers will see in the near term. Now, that might change in the long term, but we are seeing much more competitive pricing coming out of China, and that's depressing a lot of the prices of tokens from our US companies as well. So our read on that is basically because of the build-up, because of this AI bubble, it provides a concentration risk that we have to mitigate. And we're telling our clients to keep their capital diversified into other non-AI focused equities and in alternative assets as well, into hard cash flowing assets. So we're saying remain diversified. On the private credit, private debt side, we saw Blue Owl come having their problems early on this year, January timeframe, where we saw roughly their stock was down about 68%, a number of redemptions, but we're seeing that spread across multiple firms now, not just Blue Owl, but across the industry for private credit into Apollo and Ares. And we're seeing many more withdrawals required from those firms. And then analysts warning of defaults in the private credit market. Now, this is focused on private credit, focused again on software heavy companies, SaaS collateralized companies. And so it's not industry wide, and it doesn't affect private debt. So private credit is for corporate debt, essentially corporate lending. But we have focused at Clive Capital on private debts allocation that is restricted to loans collateralized by real estate and infrastructure, not by SaaS or enterprise software. So that's what our recommendation is. Let's move on to real estate. So first and foremost, multifamily. We're seeing that national apartment rents have been barely moving in some markets. So you'll see the mountain, you'll see south, but Pacific and the Midwest and Northeast have inched up slightly. You see the 1% to 2%. It is regional. We see a lot of oversupply in the mountain regions, and so they'll remain negative in the trailing 12 months, and we remain selective what we look at. For retail and mobile home parks, we see that there's a bifurcation. So grocery anchored strips and Class A malls thrive. They're seeing 95% occupancy. B and C have seen some structural distress. You'll see C and below is experiencing 72% occupancy. What has driven that? It's elevated oil prices. We talked about this C-shaped economy. Oil prices are taking a hit on household budgets and discretionary retail spending, but that's not applicable to mobile home parks. Mobile home parks remain resilient. Why? Because they're still trading at compressed cap rates, and it's because they're scarce. Not a lot of communities are allowing mobile home parks to expand, but those that do remain resilient in terms of pricing. So that's great. And then from a commercial or commercial real estate perspective, we are seeing a resurgence of commercial real estate. It's risen about 16% in 2026, back to pre-pandemic averages or almost back to pre-pandemic averages. But we are seeing that about $3 trillion of commercial real estate debt is maturing in 2030. And with interest rates ticking up, that remains a risk, a refinancing risk. And so we have to continue watching for that. All right, other asset classes, oil and gas, I spoke about that. US crude output has hit a fresh record, right? And we remain overweight on oil and gas, primarily because we see that oil and gas pricing is not going to change anytime soon. Even if we open the Strait of Hormuz, the infrastructure fixes that are required in that area are not going to change overnight. It probably will be a 10-year endeavor. And so oil and gas will remain high at some point, and so we remain overweight in that asset class. Debt markets, we continue to like debt markets. That's separate again from credit markets, where the blue owls of the world are seeing significant pullback. Debt markets, on the other hand, those that are real estate backed private debt opportunities, we see that as much, much safer. And we'll see what the Fed does in September. They'll likely maintain interest rates, but even if they raise interest rates a little bit, it will impact debt markets just slightly. Private equity, we haven't invested in private equity to date, but we are very interested in private equity. As a whole, the industry that is interested in private equity have about $3.7 trillion in private equity dry powder. They're very interested in investing. Deal volumes have dropped in the first half of this year, where average deal sizes are up about 4 times. Because of AI uncertainty and the Middle East, investors have remained slightly selective, and we've remained selective, and we've continued to assess the value of opportunities that come across our desk. And cryptocurrency, really quickly about that, Bitcoin has been trading down from the January high, and we saw a slight bounce, but we remain conservative at what we look at in terms of cryptocurrency. We're looking for the right cryptocurrency adjacent opportunity, not necessarily investing in cryptocurrency, but we're continuing to evaluate that asset class. Okay, so our thesis for the second half of this year, oil and gas. We talked about that in ad nauseum, but we remain bullish with oil and gas, where operators are benefiting from the Iran Hormuz driven price hikes. And so we think that it's a great asset class. It's also structurally favorable from a tax treatment perspective. So we're bullish on that. We're bullish on private debts collateralized by tangible real estate. So we stay bullish there, and we stay away from private credit again. But then value added multifamily in supply constrained metros, we continue to see value there. We're underweight in other developments where there is excess supply and where we are seeing negative rent growth. We, again, are not looking at private credit for all the reasons aforementioned. And then long duration treasuries, we saw what's happening in the 30-year bonds, where the yields are rising to highs. And so that's going to just depress the pricing of bonds. So we are underweight long-term treasuries. Our thesis, we remain conservative. We try to look at operational excellence and only align ourselves with operators that are excellent in terms of how they operate. And then we underwrite at conservative rates, 5.5 to 6.5 cap rates. We'll stay selective in the entry pricing. We're not going to succumb to any FOMO, either in real estate or in AI or in an adjacent asset class. And we also try to maintain a liquidity premium. We'll keep our powder dry until we see something that comes across our desk that makes sense for our investors. With that, I'm going to hand it over to Keshav to talk about our portfolio.
Thanks,
Keshav?
John. So this is where our investor capital that's been deployed stands and just the performance of it. We've diversified almost $13 million across 1,200 apartments under renovation, 100 single-family rental homes under development, 56 oil and gas wells, and 20 industrial warehouses. And that's across almost 100 investors. And these are just Q2 figures. So the asset classes that we've diversified into, you can see here. We've diversified into private debt as well, but there's no specific tangible metric that we can assign to that, whether it's a door count or a well account. Okay, so looking at our multifamily and built to rent value add, these are properties that residential properties, obviously commercial scale that we've acquired that were cash flowing day one across 4 different states: Virginia, North Carolina, South Carolina, and Texas. And the return range is between a 16 to 21% IRR, equity multiple between 2.2 to 2.4, and average cash on cash of 6 to 8%. So these are producing cash flow. Most of the projects are at or above projections. There's one apartment complex in Texas that has paused distributions, and another few that have decreased distributions. They're at half distributions. And that's because Texas, a lot of the big Texas markets were inundated by supply from the COVID era when rates were near zero. Everyone was just billed. And so they increased supply a lot, and that just puts downward pressure on rents and prices. In addition to that, elevated insurance costs have also hit us as well, hit us negatively in that market. And so that's exactly why, even if it's a big market like Texas that everyone's always, at least in the last decade, has been very bullish on, it's important to still stress test these opportunities and make sure that you're underwriting them conservatively. And sometimes it's even opportunities in secondary markets, the ones in Virginia, North Carolina, South Carolina, etc., that are not your big names like Phoenix, Miami, etc. And those smaller markets are more steady. They're not boom and bust, rapid ascent, rapid descent, but they're also much more steady and much less likely to go sideways. Our built to rent development that we've invested into, this is 102 units total located in Louisiana. We're projecting a 20.4% IRR and 2.24%, 2.24x equity multiple. 61 of the 74 units, so 82% are currently leased, and the remaining 28 units are still being built. So we are slightly missing projections here, and that is because the local government changed the requirements, construction requirements on us. Originally, we were going to just hook into the existing sewer connections, and then they came back and told us we had to build a sewer plant separately on site. That cost an extra 800K that we had to go back and raise capital from investors for. And it also delayed construction by about a year to get that sewer plant built on site and properly tested, approved, etc. Next, we have the industrial fund that we invested into triple net lease. Since inception, the fund's deployed about 75 million across 20 different assets, 20 different warehouses, and 11 unique tenants into 100% the sale leaseback triple net structure. And the states where we have the biggest footprints are Indiana, Colorado, and Missouri, and a good amount in the Midwest as well. Here, we're projecting a 14 to 16% IRR and 6 to 8% cash flow over a 6-year period. So this one I would say is performing at projections. They have basically deployed all of their capital now and are now in the operational phase of executing on these leasebacks and adding value where they can to these long-term contracts. Next, we have our debt funds that we've invested into, real estate backed, once again, not software backed. And so our cash flow fund invests into short duration mortgage loans, again, backed by real estate, and that's currently achieving 12 to 14% yield to our investors net. So after all fees and profit share, everything, our investors are achieving 12 to 14% annually. And it's just a 3 month lockup. So it's a great way to get started with us, to try us out and see what these alternative investments look like because the commitment period is so low. And these are monthly distributions that our investors are receiving, true passive income. On the right-hand side, we have our mezzanine debt fund, which invests into a similarly short duration mortgage credit. And the leverage there is slightly higher. So it's a 15 to 16% yield net to investors. And it's a 1 year lockup. So slightly longer lockup, but this is our investors' second favorite investment because of the great returns, the lower risk, and the short 1 year lockup period. And both of those funds, going back here, both of them are performing at projections, and they're a fan favorite of ours and our investors. Lastly, we have oil and gas. And so we've invested into three projects. We just closed on a fourth one about a month and a half ago. So the first project, almost 2 years ago now, was into 8 oil and gas wells. And that one is performing a little below projections. That is because there were some pipeline repairs that had to be made because of some damages that happened when you're drilling miles beneath the ground, beneath the surface of the ground. Obviously, there's a lot of different things that can go wrong. And so that one is performing a little behind schedule. That's invested into two different companies. We had another opportunity this time last year, basically summer 2025, another 8 oil and gas wells. We invested into two different companies as well. Similarly, there were some pipeline and midstream repairs that had to happen, but now those are ramping up also. And those are one-time issues that happened. And in some cases with these delays, it is a benefit because now, when these companies are producing oil, they're producing oil at $80, $90 a barrel. Whereas just 6 months ago, if they were producing, they would have produced it at $60 a barrel. So sometimes delays can work in our favor in oil and gas. Lastly, we closed a fund at the end of last year, December 2025, 37 oil and gas wells where that was diversified across 8 different companies. So the diversification is much greater, meaning a delay on any individual project has much less of an impact than it did on previous projects. So here we're generally targeting a 2 to 3x over a 7 to 10 period across all three of these opportunities, not including the initial tax benefits that investors get, which is between 80 to $90,000 of deductions that they can use against W-2 or business income per $100,000 invested. So next, company updates. Our capital, so we're coming up on almost $13 million raised soon. I hopefully shouldn't have to say almost, and I can just say 13 million. And most of that, approximately 6 million of that, is into oil and gas, which our investors love because of the tax benefits and the passive income. And also, we've had a great opportunity over the last year and a half, almost 2 years, to acquire when prices were really low. And so at the time, a lot of our investors and investors in general were not very excited about investing into oil and gas. There was a lot of headlines also going around saying, hey, the world is going to go into an oil glut. Oil is going to hit $40 a barrel. A lot of alarmist headlines. And look at where we are now. We're at $90 oil, and we even briefly topped $100 oil. And our thesis there, which we correctly called, we couldn't have foreseen why it was going to increase, but we just knew that oil doesn't stay long stay low for too long. And that's because when oil stays too low, companies go out of business and companies and countries together cut back on production. And so it's like a pendulum. When prices get too low, producers cut back until prices start working their way back up again. And so this increase was coming. We just didn't know when, but it is here now. And that is something that we were able to luckily position ourselves and our investors ahead of and position ourselves well for this, what we believe to be a higher for longer oil environment. Another 32% is allocated into private debt, private credit. And that is because of all of the inflation that we have seen coming out of COVID. Rates had to go back up to what was historically the average, the norm. A lot of people think this is a high rate environment, and this is really the norm for where the Fed has operated for the most part for the last few decades. And especially now with a lot of this inflation from the Iran war, we don't see interest rates coming down anytime soon either, unless there's something drastically happening in the jobs market. So we're bullish on private credit as well. And next, the rest of our portfolio is mostly allocated into real estate acquisitions in multifamily and triple net lease. And we have a small percentage invested into ground up built to sell from our new real estate fund that we just launched, Clive Capital, and a small portion allocated into our ground up built to rent projects as well. In terms of cash distributions this quarter, across our 100 investors, we've roughly distributed $261,000. $112,000 of that was from private debt. Another $1,000 was from multifamily and another 1,000 from industrial. Those numbers are low because the capital allocated is lower, but also these are cash flow figures. So cash flow in real estate is 5 to 6%, whereas in private debt, it's more 12 to 16%, more than double. So that's why the distributions are a lot higher as well. And oil and gas is $145,000 that we distributed in the last 3 months. That is because most investments, they return capital mostly at the end of the investment because of appreciation. Oil and gas is very cash flow heavy, and it's a depreciating asset and depleting asset. Over time, your returns decrease. So most of your returns are front loaded. And so that's why in just 3 months, we've distributed $146,000 in oil and gas alone. And so what's next? So number one is our ongoing open office hours. If you have any questions about the macroeconomic environment, about your current investments, about alternative investments, tax strategies, estate planning, retirement planning, life insurance, all of the different aspects of wealth management that we now handle, attend the office hours and we'd love to discuss it. Number two is our advanced tax strategies. So these are now open to the general public. Last year, we only opened them to active Clive Capital investors, but this year we have many more strategies to help offset W-2, business income, capital gains income, retirement income. We can help reduce the taxes on all of those. And the deadline here, the hard deadline is Christmas. But historically, the best strategies start running out in September. And so you can wait until November, but some of the downsides of doing so, number one, is that our bandwidth is limited. If everyone waits until December, then we don't know if we'll be able to get to the last person in the line by December 31st. That's number one. Number two, some strategies require active participation of 100 hours, similar to short-term rentals, for example, which is not one of our strategies because in our opinion, that's a very basic strategy and our strategies are much more sophisticated and much more effective. But that 100 hours requirement sometimes still sticks even to these advanced tax strategies. And the more time you have in the year to get those 100 hours in, the better. If you wait until December, you have to do 25 hours of work a week to hit your 100 hours to remain compliant with the IRS. And lastly, is one of the benefits of executing tax strategies earlier in the year is that you're able to reduce your withholdings, whether it's from your W-2 income or your quarterly payments as a business owner. You can reduce your withholdings knowing you have these deductions from these tax strategies coming in. So rather than going through the hassle of paying more, getting your deductions, and then waiting for a refund, you can just pay less upfront instead. And this is also especially important because IRS refund times have increased. So again, rather than having to painstakingly wait for your refund, just pay less upfront anyway, which you know you can do because you have these strategies that you've executed in your back pocket. Next, we're continuing to expand on our mission to grow and become a one-stop shop for wealth management. So we're becoming our client's single point of contact for alternative investments, tax strategies, retirement planning, financial planning, estate planning, life insurance, and asset protection, and many more. If it involves finances and wealth, we're getting involved in it. Now, we're starting with some of these basics. So we're able to help look at your holistic picture and not just how to grow your money, but how to keep more of it, how to pass it on to your loved ones, etc. So if you have any questions there, feel free to reach out. And lastly, we are launching a referral program. So with the tax strategies that we're rolling out, Clive Capital is now excited to announce that we will be sharing our fees with our referral partners related to the tax strategies. So if you refer over a friend and they execute a tax strategy with us, we're happy to share some of our fees with you as a thank you. This is something that we're really excited about. Probably the highlight of this quarter is this meetup that we're hosting. So it's called Taxes and Tickies. We're hosting it Saturday, September 12th in Fremont, California, in the Liberty Room in downtown Fremont. Here's a QR code to sign up for the event. And we're going to be talking through all the advanced tax strategies that we're helping our clients implement. And again, we can help offset W-2 income, business income, capital gains, retirement income. You think of it, we can find a way to do it. So just an illustrative example to show you the power of reducing your taxes. If you earn roughly $500,000, you might be paying in approximately, depending on where in the country you live, especially some of these higher tax areas, 100 up to $180,000 in taxes, 36% of your income between state and federal combined. What if you could reduce that down to just paying $80,000 in taxes? And imagine you had an extra $100,000 back in your pocket every year that you can then reinvest and compound and grow. Just through tax savings alone, you're going to make an extra $1 million a year in a decade. That's not even accounting for if you had invested that at 9, 10, 15% income. So this is very big. And this is now actually becoming one of our top priorities to help our clients implement is these tax strategies. And alternative investments are actually coming second because a tax dollar saved is a dollar earned. So, and we also launched our own real estate fund. So this is an Atlanta-based fund. My partner on this real estate fund is a contractor who's born, raised, currently lives in, and has been building in Atlanta for the last 12 years. So between him, his partners, and myself, we've deployed over $40 million of investor capital, built over 100 units. That's all his and his partner's experience. And we're 100% on time and on budget. And we're vertically integrated because my partner owns the firm that we'll be contracting the construction out to. We're acquiring a lot of these properties off market. We have buyer pipelines in place, direct relationships with Invest Atlanta and Atlanta Housing Authority. And we have execution speed on our side as well. In general, we're targeting at least an 18% return, if not higher, with a preferred return of 8% IRR. So we need to get you your money back and an 8% return per year for us to share, for us as the operators to share in any percentage of the profit. And the whole period is between 12 to 36 months. So these are shorter duration investments, not your typical 5-year real estate lockup. And here are some properties that my partner has built out and the annualized returns and profits for them as well. So if you're a retail investor, just a normal investor, or if you're a fund manager or some other capital allocator looking for new operators to invest with, we would love to have a chat. We're scaling this opportunity. We're primarily focused on ground up development, built to sell, as well as built to rent in Atlanta. And we have our contact information down there below. Lastly, here's our contact information, our phone numbers, emails, and Calendlies, our calendar links on how to contact us. Now that we're coming into, this is the really second half of Q3, we're almost in Q4. Our primary focus is really going to be scaling our real estate fund that we just launched and the tax strategies because the hard deadline there is December 31st. After December 31st, no matter what you do, you can't go back and offset your taxes for 2025. So just coming back here again, here's the sign up QR code for our meetup in California. And we'd love to see you there. Bring a friend. There's gonna be food and coffee. It's gonna be a great time. And that is our recap for Q2 of 2026. It's been a busy quarter as we expand into the number one, holistic wealth advisory space, and number two, launch our own real estate fund as the operator. So not only are we a fund to fund manager now, number one, number two, we're a holistic wealth advisor, strategist, and number three, we're a real estate sponsor, real estate operator ourselves. So we have a lot going on. Would love to help you invest with us, save on taxes, partner with us, etc. And we're excited for the growth to come in Q3. So that's the recap for Q2 2026. I'm your founder and principal of Clive Capital and my partner, John Lai.
Thanks, everyone.
Yeah, so thank you for tuning in, and we'll see you in 3 months.